Wanted to take a look at UVXY stock. The VIX over the past couple of days has shot up. We got our PCE deflator information on Thursday, just prior to a 3-day weekend. Nothing really occurred. Everybody seemed to have been on holiday going forward. Then Sunday night, the stock market started realizing that inflation expectations are probably not going to be met by the Federal Reserve. And so the stock market itself started selling off. Sold off pretty sharply on Monday, then continued through on Tuesday. I stepped in and I thought, we're right in front of non-farm payrolls, a much bigger number, I believe, coming in on Friday, and that the VIX itself moved up too high too quick. I sold a few options on UVXY. I tried to get into some more positions Wednesday, but wasn't able to get my fill. Regardless, Friday's number, the VIX should settle down somewhat. Put-call ratio spiked up a little bit, and I believe those puts are probably going to be sold back, and that will bring the put-call ratio downward and also bring the VIX downward. My thesis on this is simple. I don't really see a catalyst for non-farm payrolls to be too high that would shock the market and all of a sudden we'd see additional selling. In fact, I expected the S&P 500 will probably turn right back around and head right back upwards. Given that, selling calls on UVXY stock for me was kind of a no-brainer stepping in on Tuesday. Let's jump in and I'll show you what I'm looking at for UVXY stock. Before we jump in, real quick, I do have one quick announcement. I did take about 18 days off. I had some things going on in the background, and I just needed to take a break and get some of those things done. Didn't quite finish, but I expect I'll be able to continue my content as I've been doing. In the meantime, I'm also shutting down my website and instead moving to Substack. I'm importing everything, and I'm going to do a little bit of the import every single day. I put some new content up today. If you're looking for the free email newsletter from my Substack account, the link is down below. Let's jump into, here's a look at the VIX. Now saw a pretty decent little spike up on Tuesday, and that's when I stepped in and sold some out of the money calls. Very typical strategy of mine. When I see any kind of moves like this that I think are outside of fundamentals, I'll step in and I'll sell options out of the money. And in this case, I actually earned some delta and theta because the delta actually declined. So the out of the money stock options on UVXY, and I'll show you UVXY here in a minute, I'm playing both delta and theta. Delta meaning how close is the current price to my out of the money options. Now, they were closer on Tuesday. As the VIX fell down, the delta declined. Therefore, I made a little bit of profit on the delta. Theta is time. One day goes by, and there's time erosion. I make profits there because the time decay in those stock options. So already I'm doing okay. I did put these options on with a little bit of theta, so I'm probably going to get out probably Friday after we get the non-farm payrolls. I'm always front running an event, an economic indicator, and I believe that the stock market itself, broadly speaking, the treasury notes or treasury bonds have been kind of realigning to fundamentals. The stock market's been kind of looking and saying, you know what, interest rates might not go down as fast as it initially thought. Because of that, those fundamentals are out of line with economics. The stock market's just a bit too high at these levels, yet I expect it to move higher. So I usually front run these kinds of events and get out the day of the event. Rarely do I hold on to options. I'm usually looking for that one-day event and get out. In the meantime, here's the S&P 500. On Sunday night, after the 3-day holiday, you can see that we pretty much hit that high. This coincided with the Dow crossing over 40,000. Since then, it was 2 days straight of going lower. Today, we saw a little pop higher in the S&P 500, and that's where I got my gains from selling those call options out of the money on UVXY stock. There's math involved, and this is something that's really kind of important. Even though I did make some money, I didn't make as much as I should be making because this is the put call ratio. The put call ratio basically says for every call that is open interest on call, there are puts. We're looking at 30-day options at the money on the S&P 500. What's happened today was the puts actually moved a bit higher on a ratio basis. They're now trading at about 1.078. Normally they're about 0.95, meaning for every one call, there's 0.95 puts on the books, open interest. There's math involved there. First is the ratio, the 1-for-1 ratio. Then there is the fact that those puts themselves will have value. Maybe those puts are trading at about 10, but then they moved up to 12.5, whatever they might be. I'm just throwing some numbers out there for kind of a concept. First, there's more of those options. Second, the value has expanded. That's what pushed the VIX higher. My expectations, two things. Number one, the S&P 500 will turn right back up and move upward. And with that, the put-call ratio, individuals who bought puts out of fear or uncertainty as to what might happen going in on Friday, they'll close those positions out. So the put-call ratio, the puts will go lower. Therefore, the valuation on the VIX itself will decline. There will be less puts, and those puts in value will be lower. And that's how I expect to make my money over on Friday when we get the non-farm payrolls. But then you look at this number, put call ratio is actually a little bit high. So it may be that come Thursday that individuals start taking those puts off the books. Not sure, but the move higher in the S&P 500 did kind of move some of those pricing downward. Here is UVXY stock, and as you can see, along with the VIX, it fell a little bit today. I had sold some out of the monies, and they were about 780 calls. I didn't see 780 hitting. I tried to get in this morning and sell some 760s or 740s, and I just chased the market. Didn't get anything done as the stock market kind of moved higher. The VIX itself moved lower. I expect the VIX to move lower further after Friday's number. Here's a look at non-farm payrolls. 200,000 is sort of what the market is expecting going into Friday. I'm taking the under. I don't think we'll hit 200,000. Where's the catalyst event to really drive this economy further? This is kind of my take as to where we are at this point. We're at 3.7% unemployment rate. It used to be that 5% was considered full employment. So at 3.7%, how much further can this economy push and put more people on the payroll? Yes, the economy is doing well, but the rate of growth is what I'm starting to focus on. That we got GDP numbers that came out just a couple weeks ago. Those GDP numbers going into the next quarter are probably going to be lower. Not a recession, just lower growth rates. That'll be bad news for the stock market because they're chasing yield. But it'll be good news for bond yields. In the meantime, looking at Friday's number, non-farm payrolls, I expect to be meh. That's about what I expect this number to come in at. 3.7, 3.8% unemployment rate. A slight decline there with not as many jobs printed. That will send the VIX lower as the stock market rebounds. Bonds themselves likely to, yields will likely soften and come back downward. TLT stock, which I just put a trade out on, or a video out on yesterday from a trade I put on earlier in the week. TLT stock, of course, I expect that to move higher. Here is sort of the foundation of all my analysis when I look at the economy and try to figure out what's going to happen with the stock market. Personal incomes turns into personal expenditures, which turns into revenue for companies, and then profits, which drives the stock market. We're sort of in this level where we're sub-median numbers on both personal income and personal expenditures on a year-over-year rate of growth. I expect it will probably be stuck in this sort of range and no real push to say 4% on personal incomes, which would really generate a lot of growth in the economy. Expenditures, I expect, will also remain a bit sluggish. Because of that, unemployment growth rates are probably going to decline as personal income growth rates and personal expenditures growth rates decline. This isn't saying a recession just yet. We might see some slowing down, but that's just the rate of growth. We've seen some pretty decent rate of growth movements, and that's what's really driving sort of the stock market itself. But I'm looking for Friday's number to come in softer than expected, and the stock market will probably pop a little bit higher. The problem with that is, and I'll put an asterisk on that, is that if we start to see numbers declining too fast in employment, stock market could sell off, and that could spell danger for my position. But I don't think we're going to see that just yet. I'm looking for those events to start to occur in September. Nonetheless, make sure to hit the like and follow button, and my link for my Substack is down below. I have been putting content up there, new content. I am importing anybody from my old website, and I am going to put the old content up there as well. So make sure to hit that, get the free email newsletter, like and follow. Thanks for the great comments. We'll see you in the next video.